did you know that you might be able to buy a house for 4 to 4.5% interest rate today?
And no, we're not talking about assumable loans or going back to 2021.
Right. But you could get an assumable loan.
It's true.
They're just harder to come by. We haven't done a lot of them.
No.
But we've done something called a rate buy down with our lender. We have a lender locally here in our office with us, but a lot of lenders can do it.
Yes.
And so it's not something that has to be done with us, but we do have one that it's nice to be able to just be working in the office with a lender that is right there to be able to help you get pre-qualified and talk about these different options.
Yep.
Because at the end of the day, we're not the lender.
Exactly.
Right. So we're sharing information that then you would want to be able to
get a little more clarity on.
Yep. Cross-reference our information, make sure that we're telling you the truth.
Yeah, it's not something that's super, I just don't think a lot of people even know what a rate buy down is. So that's why today we're going to start kind of break it down for you guys.
Yep.
Yeah.
And we got some cheat sheets here in front of us just to make sure we're saying the right numbers. But, the most common thing that we're hearing from our clients today and why we wanted to make this video is rates are kind of expensive. I think yesterday, which we're in June now of 2026, it was at 6.6% for an interest rate. So we've got these options called a 3-2-1 buy down, a 2-1 buy down. We're also doing a promotion with our own clients right now where you can get a 1-0 buy down for free from our lender, which all of that means that if the rates are today, let's just use 6.5 as an example.
Sure.
And you wanted to, let's say you and your fiance are looking at properties. We'll use you as the real life example. Okay. And some of this can be a little tricky because let's say a house hits the market today that's perfect for you.
All right.
But there's multiple offers on that property. It's going to be harder for us to get what a seller credit would be to allow us to do this buy down instead of you paying for it yourself. So a strategy for this could be that there's a house on the market that is maybe listed a little bit too high. It's been sitting for a week or 4, and it's something that really works for you guys. Maybe it has a little bit of some fixing up that you would want to do. But you could go in, let's say the house is $1 million just on the average of that, right?
Yep.
And it's 6.5% today. If we did a 3-2-1 buy down, the first year you would be 3% less. So you'd be at 3.5%.
Wow.
Right? The first year. The second year, you'd be at 4.5%. The third year, 5.5%. And then that fourth year, you guys would be paying the today rate of 6.5%. So if we do the math, which we can try to maybe do and put up on the screen while we're talking about this, the difference in your monthly payment at 3.5% on $1 million and 6.5%,
huge.
It's huge. And so you factor that in over the course of those 3 years, and the seller is giving you the credit for this whenever we're writing the offer on paper. Okay. So the offer comes through with us asking for a seller credit. We get with our lender, that seller credit is going towards the rate buy down, and then our clients are getting the significant drop on their interest rates.
Yeah, wow.
We've been doing this for our own clients.
All the time.
Right? And so
no one knows about it.
No one knows about it. So it's like, why are we, so we decided to make a video, right? It's like, let's make a video and share. Educate. Why are these things working well for buyers? And so the idea behind it, and some people say, well, it's still going to go back to the 6.5%. That's like the pushback you could get. That's what it's at today anyway.
Yeah.
So there's 2 ways to look at it. Is during that 3-year window, our goal would be that if you can refinance, you can then come back and lock in a good rate at maybe 5% or 5.5% for a new 30-year mortgage before you get back to the 6.5%.
Yep.
The safety net for me is during that 3 years, you're saving a ton of money.
Oh. You wouldn't have been able to buy a home if you didn't do it, most people.
And if rates don't come down to where you refinance, the thing for me is there's 2 ways. It could be higher, which means you're now locked in at 6.5 instead of maybe it's at 7. We don't know what the next 4 years look like.
Exactly.
So that's one big thing. The other thing is if it does stay around the 6.5, and you don't really have to refinance, then you got into the house, you got your equity going, you're now a homeowner, which is going to save you. You're writing off your interest on your taxes. There's a lot of things that benefit you from doing that. Plus, you saved a lot of money on the interest
over
those
the last
3 years.
3 years.
Right.
Yeah, instead of renting or doing anything else with that money.
It gets you going.
Yeah.
It gets you in the game. And
more than you would have if you were at the 6.5 3 years earlier.
Totally.
Yeah.
So that's the 3-2-1. A 2-1 buy down is the same exact thing. It would just be less of the seller credit, so you don't have to ask for as much money. And you would have 2% down that first year, 1% the second year, and then you'd be at the 6.5 on the third year.
Yeah, wow.
whenever you're getting qualified with the lender, you're getting qualified at the 6.5%. So we're showing you what those monthly payments would be whenever you're paying that full amount. And then you just get a discount for those previous years before that to get you back up to that number. Does that all make sense?
It does. And it doesn't sound like there's a huge downside. What would you say the biggest downside is?
The biggest downside would be if you're holding back today because the like 6.5% is just more money that you want to pay.
Yeah.
At year 4 or 3, depending on which route you went, you will have that payment. So you know, this temporary buy down of like the 2 or 3 years that you're really loving that payment is going to go back to where maybe it was too high for you. So there's different ways I talk to our clients about that.
Yeah, and it's like you have to go in understanding all of the options before you do, like you're saying, go into it. Because then if it does stay at that rate, which you're maybe not comfortable with, then you have to understand that and either not do it or, like you're saying, hopefully something will change in 3 to 4 years, depending.
Yep.
Yeah.
And so there's also some cool things about it where, let's say that we have a credit for, you know, $25,000. It's going towards your buy down, and interest rates start coming down this year and next year like they're expected to, but we've been saying that for a few years.
Exactly.
So you don't know.
Yeah.
But if they do come down and you end up refinancing and you still have some credit left over from your 3-2-1 buy down, your lender can still use that credit. You don't lose your money. So you can use that credit towards your refi and putting it back into your expenses there. So that's a big benefit as well.
Huge.
So not a lot of downside.
Yeah, no.
You know, and we've done this with 3-2-1s, 2-1s
for the last couple of years.
Yeah, and it's been a great tool to help people get into a home because if you do factor in the home ownership and appreciation of the home, and then just helping make sure that within that 3rd year you can afford that payment, if you can't refi, that works for you and your family.
Yeah, exactly.
Any questions?
I don't have any questions, but if you guys do, please let us know. We would love to make another video, or if you want to call us for any thing specific or to talk to our lender, please reach out.
Yeah, I think the big thing for us, it's actually coming into the office and just saying that you want to do a buyer consultation where we can sit down with you, give you all the options. You can sit with our lender. We don't have to run your credit. You don't have to start looking at houses right away. It could just be a first step for you to get in the door. And we do that. We do really well with first-time buyers, or not even first-time buyers, but you're just looking to kind of get an idea of where you're at.
Yep.
Anything else?
I think that's it.
All right. Talk to you guys next time.
Bye, guys.